Welcome to Talk Tickers. Today we're diving into Park Ohio's third quarter earnings, and it's a classic tale of two stories. You've got management painting this really optimistic picture of a big transformation, and then you have the market, which reacted like it just didn't believe a word of it. Okay, so here's how we're going to break it all down. First, we'll look at the Q3 results, the hard numbers. Then we'll dig into management's turnaround story. After that, we'll see how the market actually reacted, which was not great. We'll try to figure out why there's this huge disconnect, and finally, we'll wrap up with our own rating on the stock. All right, first up, the results. And really, there's no way to sugarcoat this. The quarter was just a clear miss of what Wall Street was hoping to see. You can see it right here. They came up short on both the top and the bottom line. Revenue was $399 million when analysts were looking for something closer to $418 million. And then you look at adjusted earnings per share, just 65 cents when the consensus was all the way up at 83 cents. So yeah, not just a small miss. That revenue miss comes out to about 4.5%. And what that really signals is that industrial demand might be a bit softer than people were banking on, which is a key headwind for a company like this. But this is the number that really stung investors. A 22% miss on earnings. I mean, that's not a rounding error. That is a significant shortfall. It's kind of the result of a double whammy. Sales were weaker and their interest expenses were higher. So the numbers were bad. But if you just listen to the earnings call, you might think everything was going great. Let's move on to management's side of the story. The CEO, Matt Croaks, he basically framed the quarter not as a miss, but as just one step in this grander strategic plan. The theme was all about how they're building a leaner, more predictable business, one that's supposed to have higher margins and be less tied to the whims of the economic cycle. And this is the heart of their bull case. They're pointing to a record backlog, which is up 28% just this year. They say it's being driven by these big growth areas like defense and electrification, and they're also talking a big game about paying down debt, and then they make this huge promise about a massive cash harvest coming in the fourth quarter. And here's that magic number, $45 to $55 million. That is the amount of free cash flow they're guiding for next quarter. You know, this is their big put your money where your mouth is moment to prove that this whole transformation plan is actually working. But for all that positive spin, the market just wasn't buying it. Not at all. The reaction was swift and it was decisive. Let's look at the market's harsh verdict. And there it is. The stock got absolutely hammered, dropping nearly 9% on the day of the call. What makes it even worse is that the stock had been rallying into the report, so all those gains were just poof, gone in a single day. I mean, the contrast here is just wild. You have management on the call using phrases like solid execution and talking about a stable environment. And then you have the market's reaction, an almost 9% drop. Investors completely ignored the positive spin and focused on the real issues, like the trimmed guidance and the earnings miss. So what's really going on here? Why is there such a massive chasm between what the company is saying and what investors are actually doing? Let's try to decode this disconnect. You know, it really all comes down to this one question. Is Park Ohio a genuine transformation in progress, or is it a company with a history of underperformance and a whole lot of execution risk? Well, based on the stock's reaction, it's pretty clear which side of that debate the market is on right now. Here are the big concerns for investors. They lowered their sales guidance for the full year, which makes you question demand. Plus, this isn't the first time they've missed, so that history erodes confidence. Add in a lot of debt on the balance sheet, and things look risky. So that huge Q4 cash flow target, it's officially a prove-it-to-me story. And this chart just puts it all in context. Over the past year, the broader industrial sector is actually up 12%. Meanwhile, Park Ohio is down a staggering 39%. This isn't just about a tough economy, folks. This points directly to company-specific issues.
All right, so where do we go from here? Let's wrap this all up with our take on what to expect and our official rating on the stock.
So here's the path forward. This is the playbook for the stock to start working again. Step 1, and this is non-negotiable, they have to hit that Q4 free cash flow target, period. After that, they need to show they can turn that massive backlog into actual sales, improve their margins, and consistently pay down their debt. So with all that as a backdrop, we are initiating coverage with a market perform rating. Now, what that means is we expect the stock will probably do about as well as its peers over the next year. The potential upside of the turnaround story is balanced by some very real execution risks.
So our final rating is market perform. The bottom line is this: the company has laid out a clear path to unlock value. But after this quarter, the burden of proof is now 100% on management to actually execute. They have to deliver.
And as always, this is not financial advice.